Jarrad Brown, Australian expat financial planner based here in Singapore. Welcome to my video series where we tackle the tough personal finance questions asked by Australian expats. Today, I'm here to talk to you about the Australian dollar, Covid-19, and what it all means for our currency going forward. Now, I know we've seen a very volatile year. The Australian dollar has fluctuated wildly against most currencies, but what we're here to talk about today is what actually drives our dollar and where might it head to next. So let's get into it. Now, before we get into the key drivers for the Australian dollar, let's just take a brief look back at what's happened this year, particularly when we compare the Singapore dollar to the Australian dollar. So if we backtrack to March, as COVID was hitting the Western world, we saw the Australian dollar relative to the Singapore dollar go to 125, around 125.5. Now, I thought I was an absolute genius transferring some money back at 124, but I also thought I'd have a bit more time to actually transfer more over the coming months. Who would have thought that the Aussie dollar would have strengthened so quickly against most other currencies? Now, we then saw it trade at around the 115 level for a while, and now we're back very close to parity. And that's all been within the space of 6, 7, 8 months this year. So let's have a look at what's driving that and what are the key factors that will drive our currency going forward. There are 4 key factors when it comes to what drives the Australian dollar. Now, it's important to firstly realise and recognise that we're a commodity-based currency. Now, this should come as no surprise to most, given that most of what we export is dug out of the ground. So let's get into these 4 factors. The first of the 4 is what is called the interest rate differential. Now, what I'm referring to here is what are our interest rates in Australia relative to other countries. If interest rates in Australia are higher by a margin or significantly higher than other countries, this can often lead to what they call the carry trade. So that means people overseas, foreigners are shifting more money, more cash, back into Australia to generate a higher interest rate. Yes, they're wearing the foreign exchange risk, and that needs to be calculated, but that demand for the Australian dollar will often see an appreciation. And up until about 12 months ago, we have seen Australian interest rates relatively higher than the rest of the developed world. The second key factor is what is called inflation. So this is how much the prices of goods and services are rising in a particular country. Now, globally, inflation has been very, very low. We've seen some countries in deflationary territory, and we've seen fears of other countries heading the same way. Australia's inflation has been relatively low. The Reserve Bank of Australia has a target of 2 to 3%, and we have consistently sat below that over the latest releases of this data. Now, why does inflation lead to an appreciation of the currency? What happens when we start having inflation that's too high and above the Reserve Bank's target is the Reserve Bank needs to cool the economy. Now, one of the key ways that they do this is to increase interest rates. So the cost of borrowing starts to increase, the cost of business starts to increase, and we start to see that inflation pull back. The third key contributor to the Australian dollar is our government credit rating. Now, the Australian government has had a AAA credit rating for a substantial period of time, and relative to other countries, this has always remained relatively stable, at least over recent years. There was some fear, particularly earlier this year, that Australia's credit rating may actually get cut. We were placed on what they call negative watch, which basically means there's a chance that we'll see a reduction in our credit rating, but nothing has come to fruition yet. Now, what that means when a country like Australia has a AAA credit rating is foreign investors see us as a very safe place to hold cash, or even to buy government bonds. We've seen the Australian government raise a significant amount of money this year to pay for a lot of the COVID spending, and they do this by issuing government bonds. And the demand from overseas has been significant because, as I said, foreign investors see it as a safe place to park their money. The fourth and final key contributor is the commodity prices themselves. Now obviously the biggest one for Australia is the iron ore price. We've seen iron ore go from strength to strength, largely on the back of China and also partly driven by South American supply. But that iron ore price has remained very, very strong, up north of $100, even up above $125 a tonne, and we've not seen a lot of weakness just yet. Now, the Treasury's forecast, when we look at the Australian budget, assumes a $55 price. Now that's a long way off where we are now. It doesn't mean that we're going to see a significant reduction, but it does mean that the risk may be to the downside. And if we start to see a pullback in commodity prices, this should lead to a weakening of the Australian dollar going forward. So let's have a look at where to next. Now, where to next? This is a tough, nigh on impossible question to answer, particularly with any certainty around timeframes. We are in a very soft economic position globally. Economic growth figures all over the world are relatively soft to where we were 12 months ago, and we're not expecting a significant increase, particularly as the flow-on effects from COVID start to flow through the economy. We're expecting a bit of a softening in commodity prices. We're expecting most countries to maintain a bit of a cap on the growth of their currency or the strength of their currency to support their exporters. So what does that mean for the Australian dollar relative to the Singapore dollar or even the US dollar? Personally, we don't see a lot of movement from where we are now. Again, we could be wrong. We've seen all sorts of volatility this year, so it's important to keep an eye on it. But what's even more important is to monitor the currency exposures of your investments. What currency are you saving money in? And that needs to relate to what you plan to spend that portfolio in or those investments in the long run. So don't ignore the FX risk and monitor where the Australian dollar goes, because you may just find that there are opportunities to take advantage of as this volatility continues. Now, I hope that's been useful. I hope that's shed a little bit of light on what drives the Australian dollar and where it might go next. Thank you very much for joining us. If you have anything to add or you have any questions that we haven't yet covered, fire them through. We'd love to hear from you, and maybe we can even turn them into a future video. Thank you again for tuning in, and I look forward to seeing you next time.